Usually when you look at a scoreboard, it tells a very simple, undeniable story.
Right.
Like,
Yeah.
you look up, the home team is down by 50 points in the fourth quarter, and you know exactly what is happening. They are losing. It is a complete disaster.
Yeah. I mean, the math doesn't lie. It's almost comforting in its finality.
Exactly. But imagine looking at that exact same scoreboard, seeing the home team down by 50, but then you look down at the field, and the players are high-fiving.
Wait, really?
Yeah. The coach is popping champagne. The fans are going wild.
That creates this profound cognitive dissonance. I mean, you're forced to wonder if the scoreboard is just broken or if everyone else is playing an entirely different game.
And that exact confusion is what happens when you step into the world of corporate financial reporting during a massive macroeconomic crisis.
Oh, absolutely.
The numbers on the surface tell one story, but the reality beneath them is, well, it's incredibly murky. So today we are unpacking a really fascinating stack of financial documents, specifically the Q4 2026 earnings call transcript for Hooker Furnishings. Right. They trade under the ticker symbol HOFT, and they are the century-old legacy furniture manufacturer.
And our mission for this deep dive is to really cut through the heavy corporate jargon. We want to understand how a company survives what can only be described as a perfect storm of global and economic chaos.
Yeah.
Because honestly, this transcript is a masterclass in business resilience.
It really is.
Yeah.
But before we get into the actual numbers, I have to mention something wild about the source material.
Oh, the ads.
Yes. Looking at the media space where this earnings report was published, you've got this meticulous dry furniture data sitting right next to these massive chaotic ad headlines.
Screaming at you.
Literally screaming things like, major buy alert, Mar-a-Lago/Trump/Elon, and another one claiming to reveal the real reason Trump is invading Iran.
Which is just intense.
It is.
Yeah.
And just to pause and be crystal clear here, we are absolutely not taking any political sides on those ads today. Left, right, we aren't endorsing any of those viewpoints. We're strictly looking at the text provided.
Right, we're just impartially reporting on the environment surrounding the data.
Exactly. But the contrast perfectly highlights how incredibly difficult it is for an average investor or, a business leader to find the actual financial signal through all of that apocalyptic geopolitical noise.
Which is where the real story is anyway, I think.
Yeah.
The juxtaposition just shows the mental bandwidth required to parse out actual business data when, well, everything around it is designed to trigger this huge emotional reaction.
Oh, 100%. So let's ignore the clickbait and find that signal. Okay, let's unpack this.
Let's do it.
Here is the central mystery of today's deep dive. Hooker Furnishings reported a staggering $27 million net loss for the fiscal year 2026.
A massive hit.
Right. Yet that exact same report triggered positive sentiment and showcased a return to profitability in the final quarter.
Yeah.
So we have a massive annual deficit sitting right next to a quarterly victory lap.
It's wild. And to solve this mystery, we really have to look past those top-line headlines and dig into the actual cash flow versus what I like to call accounting ghosts.
Accounting ghosts. I like that.
Yeah. So if we look at the core facts from the source material, for the fourth quarter of 2026, their actual earnings per share was 8 cents.
Which beat the expected 5 cents, right?
Yeah, exactly. And their Q4 net income was a positive $536,000, despite overall revenue actually missing expectations.
Oh, wow.
Yeah, they brought in roughly $67 million in actual revenue versus the almost $75 million that was expected.
But then, the full fiscal year 2026 shows that massive $27 million net loss. It's completely counterintuitive.
It really is.
It's like checking your bank account at the end of a terrible financial year, seeing that you were fundamentally in the red, but realizing you somehow saved a ton of money this month despite taking a massive pay cut.
Right.
How is this math even possible? I mean, is this just financial engineering to make the executives look good?
It's not a trick, but it is the quirk of how corporate accounting rules work under generally accepted accounting principles, or GAAP.
Okay.
That $27 million loss for the year looks incredibly scary. But when you actually read the transcript, the CFO, Earl Armstrong, explains that this loss was largely driven by $15.6 million in, and I'm quoting here, non-cash intangible asset impairment charges.
Okay, wait. Non-cash intangible asset impairment charges. Let me see if I can translate that.
Go for it.
If I'm understanding this correctly, it means this is purely a paper loss. Like, it wasn't cash actually flying out the door.
Exactly.
So when a company buys other brands, and in Hooker's case, they own divisions like Sunset West and the Bradenton Young trade name, They record a premium value for the goodwill, right? The brand reputation of those divisions.
Yep.
But if the overall parent company's stock price takes a beating in the open market, strict accounting rules force them to admit those acquired brands are now mathematically worth less.
You've got the mechanism exactly right.
What?
To go a bit deeper into why this happens, when you buy a company, you usually pay way more than the raw value of its factories and inventory.
Sure.
You're paying for customer loyalty, brand recognition, the vibes, so to speak.
Right, the vibes.
And auditors require you to put a literal dollar figure on those vibes and stick it on your balance sheet as goodwill.
Okay.
But you have to test that value every single year. So if Hooker Furnishings' overall market capitalization drops significantly, the auditors look at that and say, well, the market thinks your whole company is worth less, which means the vibes you bought years ago are also worth less.
And that triggers a mandatory write-down.
Exactly.
Meaning they had to take a $15.6 million hit to their annual income statement simply because the stock market was punishing them. Not because their furniture suddenly became inherently less valuable or, I don't know, because they wrote a massive check to someone.
Precisely. And because of those strict accounting rules, over half of that terrifying $27 million loss was just a spreadsheet recalculation.
That is wild.
The underlying business didn't hemorrhage that cash. When we strip away the paper losses, we have to look at what the actual core business is doing.
Which is where the Q4 numbers come in.
Yes. Beneath the scary annual number, the underlying business operations actually stabilized, allowing them to squeak out over $500,000 in consolidated net income.
Okay, so we understand the mechanism of how they looked unprofitable on paper for the year while actually stabilizing their cash flow. But there's still a glaring issue here for me.
What's that?
Their Q4 revenues still missed expectations by almost $8 million.
True.
And looking at the earnings call, the answer to why they missed lies in a cascade of bizarre, completely uncontrollable external events.
Oh, it really reads like a list of biblical plagues hitting a furniture company.
Right. First, they had a literal calendar quirk. The fourth quarter of fiscal 2026 was exactly 1 week shorter than the previous year's fourth quarter.
Yeah.
The CFO noted that simply having one less week to sell furniture cost them $5.5 million in sales.
Just from the calendar.
It's just the calendar. On top of that, severe winter storms swept across the U.S. in January 2026, right through their largest geographic markets. They estimate the frozen weather cost them another $3 to $4 million in sales.
Which brings us to the supply chain nightmare.
Oh, man, the foam.
The foam. There was a major facility fire in Texas that completely disrupted the foam supply for the entire domestic furniture industry.
Unbelievable.
And simultaneously, the ongoing conflict in the Middle East drove up chemical and oil prices, making the raw materials required to synthesize that foam even more expensive and harder to get.
Okay, wait. I read a lot of earnings reports, and every single CEO blames the weather when sales are down.
They do.
If it rains, retail sales are down. If it snows, foot traffic is down. It always feels like a convenient scapegoat for poor performance. I just have a hard time believing a snowstorm and a foam shortage genuinely derail an entire quarter to this degree.
I mean, it's completely natural to be skeptical of the blame the weather defense.
Yeah.
But you have to look at the specific mechanism of custom furniture manufacturing. In this industry, supply chains are highly sequential and operate on a just-in-time model.
Okay.
You don't keep massive warehouses of foam lying around because it just takes up too much physical space. So if a factory in Texas burns down and you don't get your foam shipment on Tuesday, you literally cannot upholster the wooden frame on Wednesday.
Meaning it's not just a delayed couch, it's a completely frozen factory.
Exactly.
You have this expensive Italian leather sitting there aging, factory workers standing around on the clock unable to work, and capital trapped in half-built chairs taking up space on the assembly line.
Yes.
The entire revenue machine just grinds to a halt over one missing piece of foam.
And taking that a step further, you can't ship the couch, which means you can't send the invoice, which means you don't collect the cash in that quarter.
Wow.
The bottleneck effect is catastrophic. And as if the foam fire wasn't enough, they faced absolute tariff chaos.
Oh, the Supreme Court thing?
Yeah. The U.S. Supreme Court struck down certain tariffs that had been imposed under the International Emergency Economic Powers Act.
The legal whiplash on this is intense.
Yeah.
Because the Supreme Court struck those down, Hooker Furnishings is currently evaluating a refund for duties they already paid.
Right.
The CEO, Jeremy Hoff, wouldn't disclose the exact amount on the call, but he explicitly used the word material.
And in corporate accounting speak, material means it is large enough to fundamentally alter the financial statements.
So a massive influx of
A
cash.
huge influx. What's fascinating here is how paralyzing the strategic uncertainty is. The administration appears poised to pivot to new tariffs under a completely different legal authority within the next few months.
Jeez.
So Hooker Furnishings has to operate entirely in the dark regarding their international trade costs.
It's like trying to bid on a house, but the bank keeps changing your mortgage rate every hour and might retroactively alter your down payment. You literally cannot price your future. You don't know how much to charge a customer for a dining room table today because your import taxes on the wood might be refunded tomorrow, or they might double next week.
It completely paralyzes your pricing strategy. You either price too high and lose the customer to a competitor, or you price too low and wipe out your own profit margin when the new tariffs hit.
So, because the company cannot control the weather, global supply chain fires, or the Supreme Court's interpretation of international trade law, they had to take a hatchet to the only thing they could control, right? Their own internal bloat.
Absolutely. This is the textbook execution of the turnaround playbook.
Yeah.
Shrinking to grow.
Let's look at the mechanics of what they actually did, because it's pretty extreme.
It really is.
First, they divested entirely from their unprofitable divisions. They sold off Pulaski Furniture and Samuel Lawrence Furniture.
Yep.
Second, they combined two of their remaining entities, Sam Moore and Bradenton Young, into one unified division called Hooker Custom Upholstery.
Which is a huge move.
Right. And if I'm understanding the operational benefit here, they aren't just changing the letterhead. By merging these two, they can now use the exact same wooden couch frame for a leather sofa on one assembly line and a fabric sofa on another,
Exactly.
rather than designing, testing, and storing two entirely separate frames for two separate companies.
And that shared architecture drastically cuts their research and development costs, and it slashes the need for excess warehousing.
Wow.
The financial restructuring that followed is staggering. By streamlining operations, they cut their fixed costs by $26.3 million.
Incredible.
They reduced the inventory just sitting idle in warehouses by $17.5 million. And they used that freed up cash to pay off $18.5 million in term loan debt.
So they wiped it out.
Completely.
Yeah.
Going into fiscal 2027, they have a $0 balance on their credit facility and over $64 million in available borrowing capacity.
Here's where it gets really interesting. The speed of that cleanup job is just wild.
Oh, yeah.
It's like you own this massive, incredibly expensive mansion, and you're struggling to pay the astronomical heating and property tax bills. So you ruthlessly declutter it, you sell off the excess furniture, you board up the wings you don't use, and you realize your carrying costs have plummeted to almost nothing.
That's a perfect analogy.
You've survived the cash crunch, but at some point you still have to generate income.
Right.
Can a business realistically just cut its way to long-term growth? Don't they eventually have to figure out how to sell more couches?
Well, you're right. You cannot cut your way to top-line growth forever. But what Hooker Furnishings achieved here is a classic aggressive play called lowering the break-even point through operating leverage.
Lowering the break-even point. Let's
Yeah.
break down the mechanics of operating leverage for a second.
Sure.
When a company is bloated with high fixed costs like separate leases for inefficient factories, huge interest payments on debt, redundant executive salaries, they have to sell a massive volume of furniture just to cover their basic bills.
Right.
They might have to sell, 10,000 couches just to hit zero.
Because every dollar that comes in the door is immediately eaten by overhead.
Exactly.
But by shedding $26.3 million in fixed costs and paying off their debt entirely, they have drastically lowered the hurdle they need to clear just to make a profit.
Oh, I see.
They don't need record-breaking sales volumes anymore. They might only need to sell 5,000 couches to hit zero now.
Wow.
By becoming a leaner, higher-margin business, even a tiny increase in future consumer demand will drop straight to the bottom line as pure profit.
Okay, so they have successfully survived the famine, their balance sheet is spotless, and they are incredibly nimble, they're perfectly positioned.
Yes.
But here's the problem with ruthlessly cutting costs. You can build the most efficient, streamlined factory on earth, but if nobody is buying furniture because the housing market is frozen, you still go bankrupt.
Sure.
A clean balance sheet doesn't generate its own revenue. They needed a massive catalyst for organic growth.
And they need it in a terrible macroeconomic environment for their specific industry. I mean, the Department of Commerce reported that national retail sales for furniture and home furnishings are down 5.6%.
That's a huge drop.
People are simply not buying home goods.
Which makes their solution for growth wildly unexpected.
Oh, it really is.
The company is launching a Margaritaville product line.
Yep.
Yes, Jimmy Buffett's Margaritaville lifestyle brand. CEO Jeremy Hoff explicitly stated on the earnings call that this is expected to be the most impactful product launch in company history.
Which is quite a statement for a 100-year-old company.
Right. They already have over 50 gallery commitments from dealers and expect shipments to begin in the back half of fiscal 2027.
It caught the analysts on the call entirely off guard. It is a massive, highly unusual bet for a legacy manufacturer.
I'm still trying to wrap my head around this. How does a traditional century-old high-end wood and leather furniture maker bet its massive corporate turnaround on a tropical lifestyle brand known for flip-flops, parrot heads, and blended drinks?
It's crazy.
The brand identities seem entirely incompatible.
On the surface, it seems almost absurd. But it is actually a brilliant, calculated play on the psychology of consumer spending in a weak market.
Okay, explain that.
When consumer confidence is low and mortgage interest rates are hovering near 2-decade highs, people feel financially trapped in their current homes.
Yeah, nobody is moving.
Exactly. They aren't moving, which means they aren't doing the traditional whole house refurnishing that normally drives the furniture industry.
And when you feel stuck, buying a standard functional beige sofa feels like a chore. It just feels like a massive unwanted expense.
Precisely. But when you introduce a lifestyle brand with the sheer emotional resonance of Margaritaville, you aren't just selling a piece of furniture anymore.
You're selling an escape.
Yes, you are selling the feeling of a vacation to someone who might be priced out of actually buying a beach house. If we connect this to the bigger picture, lifestyle branding is an incredibly powerful differentiator when the market is stagnant. When people turn inward, they want to transform their existing patio or living room into a sanctuary.
That makes so much sense.
Margaritaville represents relaxation, an island mindset, a deliberate break from the stressful, chaotic news cycle we saw plastered all over those financial ads earlier.
So Hooker Furnishings realizes that to break through the noise of a depressed retail sector, they can't just rely on their legacy name or the quality of their wood joints.
No, that won't cut it anymore.
They have to offer a psychological experience. It's designed to punch right through consumer hesitation by offering escapism instead of just utility.
Exactly. They completely reinvented their cost structure, their factory operations, and their brand identity, all in just one brutal, highly transformative year.
And they did it because external pressures gave them absolutely no choice. It was adapt or die.
Completely.
So what does this all mean? For you listening, learning about business strategy, why should you care about a furniture earnings call? It proves a fundamental truth about business resilience. Survival isn't always about inventing the next massive, world-changing technology.
Right, not at all.
Sometimes survival is simply about ruthless efficiency, having the humility to shed dead weight, and completely rethinking why people buy your product in the first place.
I couldn't agree more. And I'd just add, if a 100-year-old traditional furniture maker finds its ultimate salvation in Jimmy Buffett, it raises a fascinating question for you to mull over.
Yeah.
If a legacy company can pivot so aggressively when forced by external pressure, what internal dead weight might you be holding on to in your own career or business simply because the weather hasn't forced you to drop it yet?
Ooh, that is a great point. If the world outside is a storm of inflation, tariffs, and chaos, the company that sells you the feeling of an island will always find a buyer. Thank you for joining us for this deep dive. We'll see you next time.